That $400,000 mortgage will actually cost you $958,000. That's $558,000 in pure interest, more than the house itself. Most people signing loan papers have absolutely no idea this is happening to them. This video breaks down exactly why a fixed payment hides a very unfair split inside it. And by the end, there's a clear path to paying over $100,000 less for the exact same house. The math starts with the monthly payment on a $400,000 loan at 7%. The term is 30 years, and that's 360 payments sent to the lender. The monthly payment comes out to $2,661 every single month. Multiply that by 360 months, and the total paid is $958,000. The payment never changes, so most borrowers assume the deal inside that payment never changes either. That assumption is where the bank quietly wins and where the borrower quietly loses. Inside every single payment, there are two buckets: interest and principal. Interest is the cost of borrowing. It flows straight to the bank as profit. Principal is the chunk that actually reduces the loan balance and builds the borrower's equity. The split is not even close to 50-50, especially not at the start. Payment number one on this loan, $2,333, goes to interest alone. Only $328 of that first payment actually reduces the loan balance. The bank collects 88 cents of every dollar the borrower sends in on day one. This structure has a name: amortization, and it's how every standard mortgage in America works. Amortization front-loads interest so the lender collects its profit early before anything uncertain can happen. It's not illegal. It's not even unusual, but almost no borrower fully understands it before signing. The bank isn't hiding this. It's disclosed in the loan paperwork. But the paperwork is long, the closing is rushed, and most people never read that table. Now look at what the first 5 years actually produce for someone paying faithfully on this loan. Over those 5 years, the borrower sends in roughly $160,000 in payments. Only about $23,000 of that actually comes off the loan balance. The other $137,000 went straight to the bank as interest, gone forever. After 5 full years of on-time payments, the borrower still owes $377,000. 5 years in, the loan is barely scratched. Most people don't know this until they actually try to sell their home and check the payoff number. And here's the real reason this matters. Most people sell or refinance within 5 to 7 years. That means the bank already collected its biggest profit before the homeowner even thought about leaving. The bank designed the loan perfectly for the bank, and that design is invisible on the day of closing. Here's the crossover point: the moment when more of the payment goes to principal than to interest. On this loan, that crossover doesn't happen until roughly month 220. That's year 18 to 19 on a 30-year loan. For nearly 2 decades, every payment still sends the majority of its dollars to the lender first. If that feels backward, it's because it is for anyone who doesn't know how to change it. The good news is that the borrower can flip this, starting with the very first payment. The single highest return dollar in personal finance is extra principal paid early on a mortgage. Every extra dollar sent to principal today skips every future interest charge that dollar would have generated. On a 7% loan, $1 extra of principal today saves about $2.50 over time. Now put a real number on that. An extra $200 a month on this exact loan. $200 a month is about $6.50 a day. That's roughly the cost of a coffee and a half every single day. That one small habit saves roughly $140,000 to $160,000 in interest, and it cuts approximately 6 full years off the loan term. 6 years of no mortgage payment. That's genuine wealth, not just a savings trick. Think about what 6 extra years of that payment staying in the borrower's pocket actually means. How much do you think you'll actually save by paying extra? Tell me your target in the comments. The second strategy is biweekly payments, and it works without adding anything extra up front. Instead of 1 payment a month, the borrower splits the payment in half and sends it every 2 weeks. There are 52 weeks in a year. That creates 26 half payments. 26 half payments equals 13 full payments in a year instead of 12. 1 extra full payment per year automatically without ever feeling the pinch of a lump sum. Biweekly payments alone cut 4 to 6 years off a 30-year mortgage, and they save tens of thousands of dollars in interest with zero lifestyle change. Most people don't know their lender will set this up, sometimes with just one phone call. Now here's the most dramatic option, one that saves over $300,000. That's the difference between a 30-year mortgage and a 15-year mortgage on the same loan. The 15-year payment at 7% is $3,595 a month. That's roughly $934 more per month than the 30-year payment. Higher payment, yes, but look at what that buys over the life of the loan. Total interest on the 15-year loan is only $247,000. Total interest on the 30-year loan is $558,000, more than twice as much. The difference between those two numbers is $311,000. That's $311,000 kept in the borrower's pocket, not the bank's. That's a new car, a college education, or a serious retirement account from one loan decision. The trade-off is real. The higher payment means less monthly flexibility, especially in the early years. But for someone who can handle the payment, it's one of the most powerful financial moves available. Now there's a trap that catches millions of homeowners who think they're being smart: refinancing. Refinancing into a lower rate sounds like a guaranteed win, and sometimes it genuinely is. But refinancing into a brand new 30-year loan resets the amortization clock completely. That means starting over at payment number 1, back to mostly interest, almost no principal. A borrower could get a lower rate and still pay more total interest by restarting the 30-year clock. Lower rate does not automatically mean lower total cost. The term matters just as much as the rate. The smart move is to refinance the rate but protect the payoff timeline. Go shorter, not longer. Refinance into a 15-year or keep the same payoff date. Never extend the clock just because rates dipped. If the refi lowers the rate and shortens the term, it's almost always a smart move. If the refi only lowers the payment by stretching it out, do the math first, very carefully. There are two other moves worth knowing before the final number comes together. First, rounding up the monthly payment. Even $50 extra a month chips away at principal consistently. Small and steady extra payments compound over time. The earlier they start, the more they save. Second, a 20% down payment eliminates private mortgage insurance from the very start. Private mortgage insurance protects the lender, not the borrower, and adds to the monthly bill. It builds zero equity and serves zero purpose for the person paying it every month. Avoiding it from day one by putting 20% down is money saved before the loan even starts. Now here's the full picture. Two borrowers, same $400,000 loan, same 7% rate. Borrower A pays the minimum every month for 30 years. No extra, no changes. Total paid by borrower A, $958,000 for a $400,000 house. Borrower B adds $200 a month in extra principal from the very first payment. Borrower B pays off the loan roughly 6 years early and saves up to $160,000. Same house, same lender, same rate, $160,000 different in total outcome. The gap between an uninformed borrower and an informed one on the same mortgage is easily $150,000. That gap isn't decided by income. It's decided by understanding amortization before the ink dries. The bank built the loan, so the borrower pays the bank first, every month for nearly 2 decades. Amortization isn't evil. It's simply a system designed to serve the lender, not the borrower. But the borrower can flip that system, and the very first extra dollar is where the flip begins. The first payment made above the minimum is the single highest return financial move in the entire loan. A borrower who understands this doesn't pay $958,000 for a $400,000 house. They pay closer to $800,000 or less for the exact same house, same loan, over $150,000 difference decided before the ink dried.